In this video, I'll analyze one of the simplest yet most underestimated models in ICT theory, fair value gap presented 930. Many traders see this model on the chart, but either don't understand what it shows or use it mechanically, without reference to the real market context. Here, I'll focus not on the name of the model, but on its logic. Under what conditions does this fair value gap really matter? What needs to happen before it appears? And how to work with it in trading so that it provides meaningful trading decisions rather than random entries. So the first thing to remember when working with fair value gap presented 930 is the time interval in which it makes sense to look for it and the rules by which it is considered valid. Time plays a key role in this model because we are working with the opening of the New York session when the main volume enters the market and the first fair value gap appears, reflecting the real price intention. First, it's important to synchronize the chart correctly. In TradingView, you need to set the New York time, UTC5, as I have on my chart. This is necessary so that the time on the chart exactly matches the opening of the session. After that, we select the time interval from 9:30 to 10 o'clock New York time, the first 30 minutes of the New York session opening. It is during this interval that the market most often shows its direction, and the fair value gap formed here is the most significant. Now, here's an important point that many people get wrong. We look for the fair value gap only after 9:30, not at the moment of opening. If the fair value gap forms at exactly 9:30, we don't use it and don't consider it valid. Within this model, we are interested in the first fair value gap that appears after the session opens. To put it simply, if the first candle opens at 9:30, the next at 9:31, and the third at 9:32, then only the fair value gap that formed after the New York session opened will be valid. This should always be the first fair value gap after 9:30 a.m., and only with it does it make sense to continue working. Once we've identified the fair value gap presented on the chart, it's important to remember that it doesn't really matter whether it's bullish or bearish. This is where people often get confused about this model. Fair value gap presented can be traded as long or short under certain conditions. Therefore, if you see, for example, a bullish fair value gap, as I have on my chart, it doesn't mean that you should immediately look for a buy. This model doesn't work in isolation. It should always be used in combination with context and overall market analysis. Remember this rule. Once you have identified a presented fair value gap, do not immediately open a position in its direction. By itself, it doesn't give a signal to enter. Next, I'll show you how to work with this model correctly and under what conditions it really provides trading opportunities. So we have a bullish fair value gap formed after 9:30. If we look at the minute chart in isolation, everything at this point is indicating a continuation of the long movement. Before that, there was a withdrawal of liquidity from the low of the London session. There is a clear target for liquidity withdrawal above, and visually the market looks ready to continue growing. But in this example, I'm using this fair value gap for inversion and considering selling. Now I'll show you exactly how I work with the inversion model of this bullish fair value gap, and then I'll explain why, in this context, it's used specifically to find shorts. To open a position, first of all, it's important for me to see a downward movement that will cause the price to consolidate below this gap. Once this happens, the bullish fair value gap turns into an inversion fair value gap, and then I wait for it to be tested. After testing the inverse fair value gap, I can open a short position with the goal of sell-side liquidity in the Asian session, and with a stop for local manipulation formed before the movement. The entire position took about an hour, and the movement worked out quite well without unnecessary reversals. Now, it's important to understand why, in this example, the bullish fair value gap was seen as a tool for inversion and finding shorts, rather than for continuing the long movement. First, there's an important rule to remember when trading NASDAQ. Always look at S&P with S&P 500. In this case, the S&P 500 chart on the higher time frame shows that the price has already removed buy-side liquidity and reacted, while on the NASDAQ, the price was still far from its target. This creates an obvious SMT divergence between NASDAQ and S&P 500. One market has already realized its long target and started to react, while the other has not. In this situation, looking for buys on the NASDAQ would be a mistake. That is why the bullish presented fair value gap in this context was used as an inversion to look for shorts, rather than as a point to continue the long movement. As I always say in my videos, any trading model must be integrated into the context. Your liquidity target is determined only from the higher time frame, and the model itself only provides the opportunity to execute the trade correctly. So let's review everything again to make it easier for you to apply this model independently in your trading. The first thing you always do before the New York session opens is to determine the context in order to understand in which direction it's most logical to use the presented fair value gap. In this case, for the current day, we see that the price has rebalanced all the downward movement, reached the zone above 0.5 according to Fibonacci, and reacted to the fair value gap. Furthermore, during the Asian session, we can see a short order flow in the form of order flow. During the London session, this short flow continued, and the market again gave a short reaction. All these factors indicate that we are in a short context. That is why in such a situation, it doesn't matter to me whether the fair value gap after 9:30 will be bullish or bearish. In any case, I'll consider the presented fair value gap exclusively as a tool for finding shorts. In this case, the presented fair value gap is again formed by bulls, so the logic remains the same. We wait for its inversion. Next, the chart shows a local withdrawal of liquidity, and a stop loss can already be set for this zone. After that, we wait for the moment when the price consolidates below the presented fair value gap. In this example, the consolidation occurs here. Pay attention that a short gap is formed on almost the same bullish fair value gap, which further strengthens the model. After that, I wait for the marked zone to be tested and open a short trade. We get a test with almost one wick and immediately see the reaction. At this point, it makes sense to open a short position with the goal of sell-side liquidity and with a stop loss for local liquidity withdrawal. Also, keep in mind that the price often continues to work around this zone, providing an opportunity to enter for those who did not make it by the opening of the New York session. As you can see, the entry model itself is really quite simple if you follow all the rules I talked about in this video. For those who find it difficult to follow these rules in practice, you can use the OWL indicator. This is not a smart money indicator, but a full-fledged trading system that works strictly according to the trend, determines the entry point, and gives a trading signal. The link to the indicator will be in the description. This trading model was originally created exclusively for trading NASDAQ and S&P 500 because it works most consistently in these markets. But for those who trade cryptocurrency, the key point remains a correct understanding of the context. As I mentioned in the previous video, the main scenario for BTC was an update of the minimum, and at the moment, this movement has already been realized. To trade cryptocurrency, I use the Evedex exchange. It's a decentralized exchange focused on derivatives, with no KYC, fast execution, and low commissions, which is especially important for active trading. The platform is well suited for context-based and intraday models without unnecessary restrictions and blockages. As always, I'll leave a link to the exchange in the description below the video. In conclusion, I want to point out once again, never try to trade a trading model on its own. With this approach, you'll only lose money and end up thinking that it just doesn't work. Any trade should start with a plan on a higher time frame, with an understanding of the context and goals of the market. And the entry model that appears on the chart is just the final confirmation, a tool for implementing and monetizing an already prepared trading plan. If you look at the market this way, many patterns will no longer seem complicated or contradictory. You will stop looking for the perfect setup and start working with probabilities, discipline, and a repeatable process. This is the difference between a random trade and systematic trading. If you found this video useful, don't forget to subscribe to the channel and give it a like. It really helps promote the content and release more reviews like this.